All right, let's go ahead and get started. Good afternoon or good morning, everyone. Thank you for joining this year's annual finance panel. We appreciate the attendance. Thank you to ABC for allowing us to come up here and share some thoughts that we are living in real time in the financing community here in the American biogas industry. We've got an hour today. We'll start off with some introductions, do some general kind of macroeconomic discussion. I'll ask each of the panelists to introduce themselves and their companies, talk a little bit about the types of financing that they've done in this space, and then we'll open it up for about 10 to 15 minutes at the end for audience questions. So if you have questions, if you could save them for the end, there should be some microphones that will get passed around. Would love to have your participation. Please don't feel embarrassed to ask anything. This is an open forum. We're not doing any presentations today. This is meant to be more of a panel discussion, kind of like a fireside chat. So we really do welcome feedback from the audience. So please don't hesitate to ask questions. Just briefly on myself, so you know the moderator today. My name is Max Vernier. I'm with Verentis Advisors. I spent the first 10 years of my career in banking, primarily in project finance. I've been in this industry since 2015. And have been involved in about 100 biogas projects in the United States in some form or fashion through different types of financing arrangements. I'm a co-founder and managing partner at Verentis. We started a few years ago to help developers raise capital in the space. We also specialize in tax credit monetization. I've been on the American Biogas Board for a couple of terms. Very excited to be here today, so thank you for having me. Panelists, please, if you could introduce yourselves and your companies.
Good morning, Allison Getchis with JP Morgan. I specifically sit within the public finance and infrastructure direct lending team at the bank. Been at the bank for 15 years, based out of New York. So we are a $28 billion book of commitments. We lend across a lot of different sectors. Our municipal lending practice covers state and local government entities, public power, transit agencies, non-for-profit healthcare, higher ed. And then about $3 billion of the $28 billion that we've deployed is specifically allocated into infrastructure and project finance transactions. So we've deployed capital into transportation projects. So think bridges, toll roads, airport assets. We do specialty real estate, and we also do renewable energy, of course. As far as RNG, so we've been following the space for about 7 years. We've deployed balance sheet capital into several projects, some of which are operational, some are under construction. As far as credit underwriting parameters, so we are typically a buy and hold book. We're a bilateral lender. Having said that, though, we have the ability to arrange and syndicate. We are a senior secured lender. We have the ability to look at single projects or portfolios of project assets under a holdco structure. We typically go out about 7 to 10 years in terms of terms, so more of a mini perm construction loan structure. We can do both taxable and tax exempt lending. And then check size, so minimum check is about 25 million. We can go up to 100. Sweet spot is somewhere between 50 and 75. And then I will also note, given that we're a large bank, we're obviously pretty agnostic around financing options for customers or clients. So a lot of times we work very closely with our colleagues, whether on the private placement desk, the high yield desk, our municipal bond desk, to dual track or even triple track financing solutions based on what we may deem a best fit for a particular transaction. Oh, yes.
Okay. Thank you.
Everything? Oh, no.
Take it from the top.
Hey, we're supposed to do the comedy.
Yeah, I'm done.
I'm David Roeder. Max, thank you for having us here on the panel, and thank you all for your attendance. I'm a co-founding partner of 503 Capital Partners. We're a niche investment management firm with about 500 million of assets under management. So we're a bond investor. We provide tax-exempt bonds as well as taxable bonds in support of a variety of projects in our space. All of my projects involve waste conversion of some sort, whether that's anaerobic digesters making RNG or plastics recycling projects. Our firm has three legs to our stool. We provide financing to charter schools. We provide financing to senior living facilities, and what I do in terms of waste conversion projects. So you can think of us as an impact investor providing debt financing for projects in this space. I've got about 35 years of experience, both in project finance as well as public finance, providing tax-exempt financing to all kinds of state and local governments and special districts here in the U.S. And I think with that, I'll turn it over to the next person.
Thanks. Tyler Bailey, Manager of Investments at HASI, formerly Hannon Armstrong. About 10 years in the energy industry, started out my career in the LPO at the Department of Energy and then transitioned over to energy development for EDF renewables. And most recently, I was in power markets or sort of capital markets, power and utilities at CIBC. So a little bit about HASI. We are a publicly traded sustainable infra investment firm. We have about $14 billion assets under management right now. About 1.2 of that is in clean fuels. So our investment team is kind of broken up across three different asset classes. We have our traditional renewables, grid connected solar wind, so large scale utility type projects. And then we have our behind the meter team. And then lastly, it's clean fuels, so the team I sit on. We look at everything, right? We do clean methanol, hydrogen, obviously RNG, and RNG is our anchor. So 90% of that 1.2 billion, just shy of a billion, I guess, is in RNG assets. So we want to deploy capital. Because we're publicly traded, we're not a fund. We kind of invest across the capital stack. We can do structured equity, we can do pref, we can do mezz, we can do senior debt. So we can do a little bit of everything. Check size, obviously, pretty variable as well. It's unique to the client. We like to kind of provide solutions, don't necessarily come with a prescriptive approach. So, that being said, we can do as little as 20 million. We can do as much as, $500 million. It just depends on the case, in the scenario that our clients need. That I'll turn it over to John.
Thanks. Thanks to the ABC for having me here today, and for Max for leading the panel. I know that takes a lot of time and effort. My name is John Ellis with Pathward. We're a commercial lender in the space, national lender. We're about $7 billion, and I work in our structured finance group. We have really three different silos on the lending side in the commercial finance division: working capital, equipment finance, and in our structured finance group. Under the structured finance group, most of that is project finance, basically focused on utilizing the USDA REAP and BNI loan programs. Each of those is up to $25 million, and it provides an 80% guarantee to the loans that we originate, and then they just provide a guarantee behind the curtain. I've been with the bank for about 5.5 years. My background is lending and credit, and then I went over to the dark side and worked for a couple of developers and EPCs in the renewable space, and then came back into banking to join Pathward and lead their efforts to develop out their biogas program. So we've been doing that for probably about 3.5 years as RNG really kind of came into favor. And we've done a little over about 1.3 billion in construction, perm, a little bit of ITC bridge financing all around the renewable space. And in the bio space, that would be pretty much agnostic to feedstock, offtake, technology, as long as it's commercialized and we can put a nice bow around the project finance parameters that we need. We'll pretty much take a look at everything. And then the USDA allows us to do a few things that are kind of unique in the space with that guarantee. That allows us to look at merchant risk a little bit. So with the LCSF markets and RINs in the dairy and swine space primarily, and then obviously RINs for landfill, that's let us kind of take a lead position in coming into some transactions over the last couple of years. Obviously a little precarious right now, and I think we'll talk a little bit more about kind of the lay of the land today, but we're pretty entrepreneurial. We're connected and working with equity investors, developers, tax equity. We're kind of involved in all of that since we come in at the construction level. So it's pretty important to have that background and understanding of all those different facets and moving parts in a transaction. So with that, I'll stop and turn it back to Max.
All right.
Thank you.
Thanks, everyone. Okay, let's jump in. So I wanted to start off with some kind of general brief responses maybe to some of the themes that I've seen here at the conference over the last couple of days. I'm sure everybody has heard some pretty consistent themes coming through. As it relates to financing, the ones that stand out for me are, generally speaking, is this industry heading into a period potentially of some headwinds? We've had a lot of tailwinds over the last few years. We've had double-digit year-over-year growth for quite a while that's been sustained. Do we potentially foresee a change in that? I also have some questions about ITCs, PTCs. We can talk about offtakes, but maybe just kind of a general reaction from the group here. Are you seeing any shifts in the capital markets, any sort of quick reactions over the last couple of months with uncertainty around macroeconomic trends, tariffs, things like that? Do you have any immediate observations to share with the group here?
You want me to, where do you want to start?
You want to
Did you
start?
say me?
I'll go.
Anyone,
Okay.
jump in.
From our perspective, it's kind of hit me straight on. We have a lot of deals that we do construction for that have been in construction for 12, 15, 18 months. And the forward curves that we rely on as we size permanent debt has, continued to say this every single quarter that we get those curves. And yet today, as I'm ready to convert to a perm loan for some of these projects, what they were sized to 18 months ago or even 2 years ago, there's a bit of a delta. So from a capital market standpoint, a lot of conversations with our equity partner or the equity partners in projects about, okay, how do we size a deal today so it's not in default and putting us at risk from a risk rating standpoint and cash flow is not there to where we think it's going to be once LCSF credits are kind of brought back into balance with the amendments that are being that are approved, but just not implemented at this point. So a lot of those kind of conversations that we're talking about with folks and looking at structuring longer interest-only periods, extending amortizations within what the USDA will do, and ways that we can try to help balance out the both sides of the coin there.
So safe to say maybe less debt on projects these days than maybe you would have underwritten a few years ago?
Correct. So, I was referencing kind of the existing portfolio, but on the look forward, we're certainly taking that into consideration. And it's unfortunate, I think 6 months from now, I think we'll see a much stronger market and curve, more marrying what the forward curves are telling us it'll look like. But today, that's tough to convert to a perm loan and or commit to debt. So we're trying to be creative and saying, okay, if the curves come true on the forward, here's kind of where we would size that. But if it doesn't, and we kind of stay down where we are today for whatever reason, due to any changes or regulatory things that remain in place, that we've got a mechanism to be able to right size that. So it's kind of, we offer it up, but we have an ability to reduce the debt quantum for the perm loan once we get there.
Yeah, Max, I would say that the headwinds have been building for a long time.
Yeah.
The last couple of years. And some of the subsidies have sort of masked the problems. But we've seen a lot of projects go over budget. We've seen them go over time. We've seen them not be commissioned in the appropriate amount of time or be commissioned to the right amount of operating capacity that we were all expecting. And of course, we've seen the revenue numbers with LCFS and D3 RINs steadily going down, it seems like. So those headwinds have been building for a long time. But when you get 30, 40% ITC, sometimes it doesn't matter so much. Well, now that there's uncertainty regarding ITCs, uncertainty about tariffs and what their impact on capital cost pricing may be, all of a sudden it's all these things taken together. It's a little bit of a cloud of uncertainty that's over the space right now. And us lenders, when we get uncertain about things, we tend to retreat to the sidelines until the fog is lifted a little bit, and then we re-enter the playing field. I wish all of us lenders were a little more courageous and would step into the fray, because there's wonderful opportunities to be in the market right now providing financing. And yet our credit teams generally get more cautious at times like this where there's a lot of uncertainty.
That's where we need good equity. So, and I would echo what Tyler said. So regulatory uncertainty, right? And that almost affects everything that we touch, not just RNG, but, a lot of our direct municipal lending practice. So, RFS reform, concerns around, tax credits, IRA reform, tax reform more broadly as it affects the municipal market, and projects that may qualify for private activity bond use. Tariffs, obviously, inflation impacts how that affects construction costs, schedule. So I would say, we are treading more cautiously, just given the general uncertainty, and we don't really know when, things will start to stabilize. But as a result of that, we are being more selective around the types of transactions that we end up pursuing.
Max, I forgot to mention one point, which is defaults. And we haven't seen as many defaults on small to mid-market size projects, but there have been some significant defaults on some really large projects, 300 million, 500 million, billion-dollar type projects. They get a lot of headlines. And again, that just adds to the uncertainty amongst lenders when you see those major defaults happening.
Generally, I would just say, based on what we're talking, I think sometimes it's helpful to have sort of the market blips that we're seeing now, because it instills discipline in the industry. It's right, we try to coach developers and clients that we work with, but I think everyone's a little bit cynical, right? There's obviously challenges and headwinds going on in the market, but it's obviously a lot of opportunities, right? It's a time to be disciplined, and from HASI's perspective, the fundamentals remain the same for us. Underwriting assumptions, it's tougher, right? I think offtake's a big challenge for us. Can you secure, have a line of sight into offtake? That's important. We obviously, out of the forward here, we're not the cheapest cost of capital. So we're not looking at, PF type checklist where you need 100% fixed volumes. So we can do a little bit less. We're willing to take merchant exposure, but to us, it's still about the market fundamentals. So we're still willing to deploy capital, but, obviously there is some uncertainty looming over us. The biggest challenge, I think, still is offtake.
So maybe a little trepidation, but it's not all doom and gloom. I think each of you are actively underwriting and closing deals right now, right? Pretty sizable transactions as well.
Yeah, just either at a little lower that quantum, like you said, or terms and conditions that are really designed to protect the project and the developer. One item we didn't talk about that I'll throw out, not to keep the spotlight on CARB in California with LCSF credits, but as we've kind of gone through the life cycle of projects coming through construction to commissioning and converting to perm, even when you convert to the perm loan, you're still waiting likely on the CI score from them to move from a minus 150 to a minus whatever the project gets. That's a lot of economics in the project that isn't there for the first couple of years, that was probably modeled in, never expecting CARB to take over 2 or 2.5 years to come back with your official CI score. So that's where we try to work on the structuring side to extend an interest-only period under the perm loan to give a little more runway for stabilization, with that being one of the major factors.
Okay. Let's talk about the tax credit for a minute. So this is the investment tax credit. So Section 48, this is the tax credit that helps pay for a portion of the capital expenses of the project. So if I'm a developer and I started construction on a project at the end of last year before this tax credit sunset, so I'm safe harbored and I have a few more years to finish my project, how can I borrow debt from the panelists? How do you think about that? Are you able to underwrite the fact that there's going to be a liquid asset at the end of construction that I can monetize to either pay for costs, maybe pay down debt? Can you just share briefly kind of how you're thinking about that right now?
Okay, so we're starting to look at bridge loans to investment tax credits in the biogas space. We did close on one recently. For us, since we are a little bit of a new entrant, although we do bridge loans to ITC credits in other areas within the renewable energy sector, we aren't looking to take naked risk. So there has to be a commitment on the other side. So that's number one. Number two is, we want to make sure that these projects have basically reached, notice to proceed. So there's, a likelihood of this project kind of reaching fruition. The other concern with bridge loans is the overall quantum of debt, right? So can, the cash flows for these types of projects, especially if you're facing a very frothy offtake market, can they support, both, the bridge loan, understanding that it still gets taken out with the tax credit, but can it still be supported by the bridge loan as well as the conventional construction debt? In some cases, determined that it cannot. So that's going to affect the overall quantum of leverage. So we think about the overall quantum of leverage between the construction loan and the ITC bridge loan, the ability for the cash flows to support that. If not, right, the leverage needs to be downsized, and or we get support from the equity sponsor, right, the developer, in the form of a guarantee or some other sort of support.
Yeah, so Max, we're already leveraging up to 80% of the capital costs of a project. It's really hard for us to then leverage further, to leverage the ITCs and provide bridge loans against the ITCs. We're a secured, project secured lender. We need to have some form of equity behind us. And already advancing 80% just doesn't leave enough cushion left for us to justify then further advancing against the ITCs, which are not project assets, right? They're financial assets, if you will. Even though we have a high degree of confidence that they're going to be received and they're going to be received around a certain timeline, it's just really difficult for us to get there. And so we have not yet provided that type of bridge loan financing to the ITCs.
I would just say our view is not too dissimilar from Allison's. We do ITC bridge loans, but pretty similar construct, right? Where we'd be looking for if cash flows can support it, if there is a change of law, binary risk. What I would argue or say on, because we can do some of the equity too, that we can do partnership style flips where we come in with structured equity. So there, an example for that, we'd take a percentage of, we won't take the tax credits, but we'll, come in and take the transfer proceeds. So a situation like that, we would size it against the cash flows, right? Rather, if there is that ITC risk. So again, ratcheting up maybe the cash flow sweep, typically look at like a 5% pre and post flip in a normal partnership structure, maybe ratchet that up to 10, 15%, assuming no ITC transfer proceeds come in, or they come in much lower than expected.
Yeah, so fundamentally, we kind of work from the bottom up. Whether it's a lesser of 75% loan to cost with a fully loaded uses budget or some debt service coverage that we've sized the perm loan to that's going to take out my construction loan. So that kind of sets our baseline, which gives a little bit of room. Historically, we've gone up to 90% with that delta being an ITC bridge, but our product is kind of clunky, much like Allison and Tyler referenced. Really, that's deferred equity. So we're looking for a way to make sure that that gap can be plugged if it's coming in at the end of the project. So this is a little more pricey than what our construction loan would be. So it's usually coming in on the back end. But we've only done that, a handful of times because they're, a lot of times folks aren't really ready to do that. We've also really looked at the ITC if we're not going to fund it up front, kind of getting a little more conservative in the market to leave a little more cushion. Let's just say we stay at that 75% loan to cost for the construction loan. We have the shadow value that we know is building by the time we get to mechanical completion that we know is transacted in the market, that we know it has a certain value and can be a commodity that can be commoditized or monetized. So we can look at that as something to fix cost overruns if we run out of contingency, to be there for perm debt reserves, for P&I or OPEX reserves, or in that example I was giving where you kind of have to right size a perm loan because the market's just not there yet on the LCSF and RIN pricing. So we kind of look at that as a real extra value proposition near the end of the project. And then I think a lot of it has to do with how that project is structured, whether you're what is the ITC number you're looking at? Is it off of the cost basis and you're kind of discounting down from what you're expecting to get off of that? Do you really have prevailing wage and apprenticeships? We kind of peel that onion. Do you have domestic content? Are you trying to get it? And do you have a way to prove it out? And then what are you assuming on any kind of a step-up structure? And what does that look like for what you're planning to do? And what value can be placed on that at the back end? So a lot of moving parts there with the ITC, but we look at it as a real piece of value that evolves as the project moves forward.
Have you all seen any tax equity deals done in biogas recently, or are all of your projects that have tax credits electing transfer? Just curious.
I guess I can go first. Most of them have been transfer as the market has evolved. I've seen within that many different complex structures to get to step up, and that's a DevCo OpCo sale or bringing in a private investor near the end of the deal to reestablish your basis. a lot of different structures and things being talked about there, but no pure P flips or inverted leases like you would typically see in a solar project.
Agreed.
Similar.
Yeah, mostly transfer.
Yeah, mostly transfers. Cool. I have some specific questions for you all. David, could you maybe spend a minute just kind of at a 101 level and talk to us about taxable and tax exempt bond issuances in this space? So for those of us who might not understand as well, there are some programs where a project can issue debt. A lender like you can support that project. What are the benefits from a tax perspective? How does that help the project? Can you just talk about that for a few minutes?
Yeah, Max, absolutely. Of course, a session on tax exemption, I could do this for like weeks and and not conclude with
2 minutes.
all the comments, but 2 minutes max. So the number one thing is your interest rate, right? Your number one issue is going to be that you can cut down your interest rate by 3 or 4 points by going tax exempt versus taxable. So let me just briefly explain. If you have a tax exempt loan or a tax exempt bond, the holder of that loan or bond, the interest that they receive under that loan or bond is exempt from federal taxation. You even have certain states that exempt the income from state taxes, so it can be double tax exempt, as they say. So it can result in a significantly lower interest rate. And think of that from your perspective as developers of projects, much lower capitalized interest, a much lower interest rate that makes your debt service coverage levels improve dramatically. I've seen some that go from 150 debt service coverage to 2 3/4 debt service coverage just by converting from taxable to tax exempt. So that's the major advantage of looking to do that. There are a variety of ways that it can be done in our space. There's solid waste revenue bonds. So a lot of us are working with some sort of a solid waste that we're converting into some beneficial second life asset. We may qualify under that. We may qualify under the private activity bonds that Allison mentioned, where you're working with a local government issuer to issue those tax exempt bonds. That local government issuer is completely non-recourse. They're just a pass-through. The full credit of the repayment obligation is with the developer of the private project. But that's another way to do it. There's even small issuer exceptions for projects that are $10 million or less. So there's a variety of ways that you can ultimately issue tax exempt either loans with a bank or tax exempt bonds with an investor like us.
Thank you. Allison, JP Morgan can also participate in these kinds of transactions, but you also do some sort of regular loans on balance sheet. Could you maybe talk about how you view those different types of products in this space? Do you have pros and cons to kind of offer up for the group? And then are you seeing any changes kind of in the behind the scenes in the syndication markets? Like, are there any kind of trends that you're witnessing in the capital markets, maybe in syndicated transactions in this sector?
Okay, so from a credit perspective, right, other than the interest rate savings that Tyler mentioned, whether or not a project is taxable or tax exempt really doesn't change anything from our perspective. We can do both. We've done both, actually, and in some cases, we have structured project financings where the borrower can actually draw down taxable or tax exempt because perhaps they haven't gotten an allocation that would cover all of their project costs. And in most cases, tax exemption doesn't cover 100% of project costs. It might be closer to 90%. So it's usually a significant proportion. So we have done deals that I think some of the challenges is, the location of the project, right? So is it located in a state that can get a conduit allocation? And a lot of times you're competing for other uses of that tax exempt allocation in a particular state. So for instance, we did one project in Oregon. The most important allocation priority for them is goes towards housing. So for $100 million debt financing that we did, they were only able to secure about $32 million against that. So we closed on a tax exempt drawdown loan for that 32, and then the rest was taxable, with the expectation that they would continue to reapply in the next year and hopefully get more allocation, and then we can, basically recycle that capacity. So we have the flexibility to do that. So, and you probably know more about this stuff than I do, Tyler, but as far as syndication, so for most of I think actually all the deals that we've done to date, perhaps except for one, we have been a bilateral lender. we are starting to see larger transactions. And when I say larger, not necessarily larger projects, because, generally speaking, RNG projects are not supposed to be too large. If they were very large, I would be very concerned. It's more aggregations of assets, right? So there's been, right, safe harboring, and everyone's looking to move projects forward and commence construction. So there's a lot of schedule overlap for multiple projects. So, because of that, and us just thinking about, our balance sheet usage and overall exposure to the space, we are starting to evaluate, syndications where we would look to bring in other lenders alongside ourselves. So, we were involved with one club deal that, John was on. That was a little bit of a different type of structure, but I think we're going to perhaps see more of that happen as we start to see larger portfolios come to the market.
Max, if I may add, I want you all to think of tax-exempt financing as just another tool in the toolbox, right? You can still use USDA senior loans. You can still use equity. You can still use taxable debt to start a project and convert over to tax-exempt debt at a later time. There's specific rules you have to follow to do that. But the tax exemption does give you that significantly lower rate. So think of it as just something extra that's available to you in the marketplace that historically has not been taken advantage of in this biogas space. The biogas space has been dominated by USDA loans. That's still there. It's still a great source of capital to the marketplace, but there's other ways you can do it that might be more efficient for your local project.
Thanks, that's helpful. Tyler. So HASI is a publicly traded company. It's a bit unique in this space. You have a lot of flexibility to participate in different parts of the capital stack. Do you think that you have any sort of additional pressure or scrutiny from shareholders on this particular asset class relative to other sustainables like solar and wind? Do you feel any sort of additional scrutiny around this?
Yeah, it's a good question. And the short answer is that, the pressure is to deploy more.
More money?
It's more. Yeah, I mean, because you think of HASI's been doing solar wind for a long time, and as most of you probably know, it's a competitive industry. It's a very mature and competitive industry. So, with that, it's a race to the bottom, and based on HASI and our cost of capital, it's difficult for us to compete there. So RNG, comparatively looking at yields or where the space is, it really behooves us, or it positions us well on what we do. So again, the short answer is that our shareholders, analysts, they want us to see deploy more RNG. They like it. Again, we're bullish on it. And given the yields and the structures that we're both kind of doing and underwriting, it's interesting, right? So yeah, I mean, I think it's deploy more.
That's good. Can you also spend a few more minutes for the crowd just talking about the types of structures that you've done in this space? So you've done some interesting things.
Sure.
With some pretty big names in the industry.
Yeah.
Can you maybe share some info about those kinds of structures?
Yeah, of course. I mean, we're covering a lot of debt up here. We do senior type debt, right, and ITC bridges. Those are, let's say, our more vanilla down the fairway options. And typically we do like to start with those, and that's what we've done at HASI, right? We're not taking a super bullish stance by doing that, but right, that's our entry into the space. Now we're starting to get a little more comfortable again, because again, being publicly traded, we can kind of participate across the capital stack. So we're looking at mezz type loan facilities at the top co, which is something new to us, but we see it as another solution, right? Our developers and our clients continue to deploy projects, and that's ultimately what we want to do. I alluded to a little bit of the structured equity we're looking at. We can do structured equity and pref type structures. So it's really dependent on what the client needs, right? So we always say we're not going to, I'm not competing with anyone up here, right? We're just in different ballparks in terms of cost of capital, right? We're not always going to be the cheapest, but we can be unique in the type of structuring we offer. We've learned a lot, right? Being in the solar and wind industry for a long time, so that there is a playbook there. But we're obviously open to creativity, right? And we want to provide solutions, capital solutions for our developers to continue growing.
Thanks. John, let's talk about USDA. So as you told us before, the Department of Agriculture has a number of grant programs and loan guarantee programs that are available to this sector. And I would venture to guess that over $1 billion probably easily has been funded towards biogas projects using these loan guarantee programs over the last decade. So it's been very important for this sector as it's grown. A lot of projects have received these types of project finance senior loans. What is the state of the union at the Department of Ag right now? There's been a lot of staff turnover, a lot of changes. Do you kind of have a crystal ball for us? Do you see these programs being impacted right now?
So that's a really loaded question. 6 months ago, I had hair like Max. So in all seriousness, there's a couple different tracks and layers to that. Kind of pre-Trump administration, there was the typical USDA, all approved under the Farm Bill, just subject to then and beholden to budgets from Congress and continuing resolutions, which have been put in place, but still some bureaucratic challenges within the program that we work on and work through every day with our clients. And we try to shield as much of that brain damage to the customers as possible, but just inherently a government program, there's things that we have to work through to get to the finish line. We always say it's a matter of when, not if, in terms of getting deals through and processing them, and that's just what we do. We've done hundreds of deals in over half the states in the country, and numerous bio deals and lots of solar and storage. So just kind of as the markets have evolved and as we've worked through that, that's just the everyday due course of business. Roll forward, new Trump administration, pause and freeze on everything. Everybody has the deer in the headlights look, layoffs, and then buyout packages. A lot of people in the USDA have been there for a long time and have taken the package and jumped out of the plane and they're gone. So we're kind of waiting for that dust to settle, and some of that is the way the USDA is structured. You've got state offices with representatives for each of the programs and the environmental, and then you have the national office, and we work with both. But the national office is kind of where we almost always end up because of the size of these projects. So we have regular and ongoing dialogue with them about what the structure looks like, how do we keep things moving through, getting approvals, and who's going to be where, and all that is kind of just a moving target. So all that to say that we're open for business. They're still open for things within the IRA. They're more focused on EV and some of the other things. They're pro biofuels, as much as I've heard and understand, or at least neutral, pro farmer. And so our programs that we really focus on, the tea leaves are pretty favorable. It's just a matter of kind of wading through some of the changes that are in process.
So the dust needs to settle a bit further, but probably expecting another revamping of these programs to the next Farm Bill.
Absolutely, yes. And in fact, there's some things that they're trying to improve, expand the amount of dollars under the REAP program, tweak what is considered eligible in terms of small business. There's a number of different. There's probably a laundry list of about 12 different tweaks that we've lobbied for and are working for within the different trade organizations to improve the programs under the Farm Bill, distinct and separate from any broader initiatives that the Trump administration is pursuing.
Can anybody talk about interest rate risk right now? So I've gotten this question a few times in the last week. How are lenders thinking about hedging their own interest rate risk? And maybe can you talk about any sort of products that you might offer or require from the customer? Does anybody want to take that one?
Let me start. Obviously rates have been very volatile, especially over the last several months with the new administration, headlines coming out affecting rates. JP Morgan is obviously, so we put out a forecast. So we are, projecting for, I think now currently 325 basis point drops before the end of the year. Fed fund rates is somewhere between 425, 450. So, we expect rates to come down. Obviously, that's good if you have floating rate exposure to your projects. Typically speaking, when we underwrite debt, we do put in a hedging requirement. So usually that's set at about 50% of the notional amount of the loan. So we can slice it or dice it one of two ways. So one is we hedge, and we're indifferent if you want to hedge for longer than the term of our debt, by the way, but at least for the term of our debt, either you hedge for the entire term, including the construction period, and then for the unhedged portion, we will put a buffer based on a forward SOFR rate index that accounts for any sort of upward movements that may affect rate, be affected by rates. Alternatively, you could execute a forward hedge after term conversion of loan. You don't hedge during the construction period. And what we would do then in that case is we just attach the buffer to the entire amount of the construction loan based on the draw schedule. And what that effectively means is you're just inflating your capitalized interest that you're sizing into the loan commitment. We do have a hedging desk that we work very closely with, so we view ourselves as a one-stop shop. So typically speaking, we'll direct borrowers to work with our team to help discuss hedging options.
I don't mean to alarm everybody, but there's market rates, but there's also credit spreads, right? So when you think of market rates, you think of like 10-year treasuries as being your sort of your base interest rate that you look at for your loans. But here over the last couple of months, as there's been so much uncertainty in the marketplace, so much volatility, the credit spreads have widened and widened significantly. I've heard some estimates of 150 or more basis points, so 1.5 of interest rate higher on just the credit spreads, not necessarily the treasury base rate itself. So something to think about. That could be temporary. I don't know. I don't have that kind of a crystal ball, and we don't provide hedging for our clients. But a real risk that you need to think about in terms of fixing a rate with those really significantly higher credit spreads, at least in the interim. Who knows what tariffs and a potential recession could do? I tend to be of the belief that we're looking at lower rates going forward, which you all take your own risk as far as that goes. If you want to go with a variable rate deal and fix your rate later, right, to take advantage of that lowering of the interest rates, maybe that gets rid of the credit spread expansion that we've experienced recently. Maybe you also pick up the decline in the treasuries. Certainly an option for you. But we've also seen times in the past when people have gone with a variable rate and then rates continue to move up and they get squeezed, right? So proceed with caution as always. This is a highly volatile interest rate environment that we're in right now.
Yeah, we don't have too much to add here, right? Because we're more credit-like, but typically, for our deals, we do tend to fix rates. Don't necessarily require any hedging, nor do we provide hedging. But typically, we're fixing our rates for anywhere from 5 to 15-year terms.
So I would put the question into two buckets. On the short side for construction, we're always variably priced. We tend to use prime more so than SOFR, but we're going to be a floating index plus a spread. And we're going to build into the construction budget, construction interest that gets me through that time period of construction, whatever the Gantt chart shows, 12, 15, 18 months with a little bit of cushion. So the downward trend on rates with what we're going to budget gives me a little more comfort that I've got enough cushion to carry interest and capitalize that during the construction loan. So that piece kind of takes care of itself in how we structure the deals and the usage schedule. And then when you convert the perm, we're also pricing off of a spread, always fixed rates. Generally, I don't want to take, and nor do I want my clients to take rate risk on top of all the other risks in a project finance scenario. So we're almost always doing a 10-year fixed rate with a spread that's kind of predetermined off of the credit profile, as David indicated, using the 10-year treasury at the time of conversion to the perm loan. So we kind of lock that in. We don't require or do any hedging, and really then our treasury folks, it's their job to decide if they want to match fund it or how they want to handle that on our books. And then the other secret sauce with the USDA and the loan note guarantee is our treasury folks have this trigger of being able to sell the guaranteed portion into the secondary market, so they can unload 80% of the fixed rate into the market and reduce the balance sheet risk that we take on the rate side, and just manage it within our well capitalized and lots of liquidity on the balance sheet mix.
Okay. Maybe one more general question before we open up to the audience. I'm really excited about this panel because you have all actually made loans to biogas projects. You all have real experience for years, and as a result, you have seasoned portfolios. You've seen projects go all the way through construction, go through commissioning, operations. You've seen the ups and downs. Can you maybe each just give the audience a couple of lessons learned that you might have seen across your portfolios over the last few years? Any key takeaways that you would want to share with folks?
You want to start?
Yeah, I'll go first. In terms of all the levers that we can pull as lenders to try to better secure a transaction, we've seen them all come into play over the last few years. Projects that have gone over budget, maybe we should have had a higher contingency fund. Projects that have gone over time, right? Maybe we should have had a longer interest-only period to help with construction. Projects that have struggled to be commissioned properly. Maybe we should have had a little longer interest-only period to cover the commissioning as well, right? There's a lot of levers like that that we as lenders can pull that's beneficial for both of us, right? Beneficial for the developer as well as for the lender to make sure that the project gets done as it's supposed to get done and is completed and up and running. I think that's been the biggest lesson that we've learned in the last, say, 5 years, Max, is that we need to be more thoughtful about those contingencies. And I know the developers don't like to hear that. Nobody wants to have extra money put into, a debt service reserve fund or a capitalized interest fund or whatever. But you also don't want to be in a situation where you're running into a default because you're over budget because of inflation, or you're over time because of a failure to commission on time. It's beneficial to both of us to have those extra protections.
Yeah, I think also just tacking on to what Tyler said, the challenge with adding more contingency or adding more runway for the interest-only period is in a higher interest rate environment, it just means your loan commitment is going to grow, right? And if we were in a lower interest rate environment, maybe there would have been more aptitude to explore those options. But we do think the same way. Also, I would say equity. So, quality of equity that's coming into the projects that, we work on. The good news is over the last few years, we've seen, a lot of sophisticated equity come into this space. So institutional funds, obviously strategics. So again, we're being very selective around the types of projects that we elect to pursue. But, we do want a strong equity counterparty or counterparties. We want someone that we know is going to step up and, support a project if things start to go sideways. And then on the construction side, I would say, EPC contracts. So, we do a lot of construction lending across the infrastructure space. So we do very large infrastructure projects. We're very accustomed to seeing, large blue chip EPC contractors that are creditworthy, providing all the contractual protections that we love to see as lenders on projects. We don't see that as much in this space. So we're starting to navigate that a little bit more, but we are scrutinizing, right? So does this contractor, are they able to, enter into a GMP for the project? Have they delivered projects in this space before? What does their pipeline look like right now? Are they working on, 10 or 20 different projects at the same time? What sort of contractual protections are we getting in terms of LDs? Are they bondable? So these are all the same questions that we're asking, but we're scrutinizing it more because of the inherent risk associated with these types of projects. So.
I mean, I'd echo both what David and Allison said here. I think one, execution is really important, right? From the developer perspective, it just makes it easier on us. Obviously, looking to lend with contingencies involved for everything, as far as delays and cost overruns, but having a history of execution is really important. Two, I would just say that, I think it's one challenge that we've seen, just with sort of lending across projects is, the equity point, I think that Allison mentioned, having that backstop is really important to make sure you can come in, you have someone not only with deep pockets that's credible and willing to, again, be that backstop for you on projects.
So excellent points all the way around, and I concur with everything that was said. One interesting example that we had on the first couple projects that we did that is a nuance is somewhat loosely tying to the EPC contract, but the level of design on which you build your usage schedule and make your commitment on a loan to cost basis is really important. So, either you have the project fully 100% or it's kind of evolving under the EPC contract, under a design construction contract. That during COVID, we had 2 projects come through that just got the cost blown out on a lot of things that you wouldn't think that really weren't under your typical MSAs or large equipment. So things like just extended time on the site, sand, gravel, insulation, concrete, rebar, things that you don't even think about under the big things you want to protect and have locked in under MSAs, or that your contract with the EPC is going to protect, that just blow out your contingency, and then all of a sudden you're like way out of whack. So that was really important, a lesson for me personally, even and within the bank, making sure that you've got all your bases covered, and if it's not, you got a really good contingency, back to David's point, to protect that under construction. And then I would say for us going into perm, looking forward, I mentioned it a little bit earlier, thinking through things that can affect my short-term cash flow before I get to stabilization, and extending interest-only periods, protecting that cash flow or lack thereof for that early period while you're waiting on CARB certification, or the cows plan or the farms plan for the growth of the herd is behind, and you just don't get to where you need to be on a cash flow basis before you start amortizing. So really thinking through those kind of things and making sure that you've protected the developer in the project in those conversations, in the modeling, to leave some cushion and plan through every one of those questions. And then, not to keep on going and monitoring or controlling the mic, but timing of when you're going to get cash. Even if you are going to monetize ITC at a -150, I'm sorry, LCSF credits at a -150, you're not going to get that cash day one. There's a quarterly cycle, and then you got a cash flow bubble that you're not going to get that money for another period of time. Well, how are you paying your overhead and keeping the lights on during that 3 to 6 month period at a lower level than what you thought it was going to be when you were modeling at a -250 or 300? So, we kind of help put that all in place and help think forward into the project as we're putting together the perm loan and the reserves that are needed to protect the project.
One other thing I would just add there too, on like the EPC point, is credible EPC partners, right? Credible EPC partners and independent engineers, absolutely paramount. I'm sure most of us have like preferred list, and I think that's super important to sometimes have that optionality. We get it, can't control everything, and you come in to capital providers at different stages, but having a little optionality there to go with a select, top tier third parties, I think it's super important.
Great. Audience, can we answer any questions you all might have? I'd be happy to. Mike? You might have to yell. Is anyone considering pre-NTP financing development capital?
No.
No, unfortunately, we're project only.
I think it depends for us. It depends on the portfolio. If it's one project standalone, no. But if there's a portfolio, if we can look at other operating assets as collateral, then there is potential.
Well, yeah, so that's exactly the answer I should have provided, which is, instead of no, if you've got another asset that we can use as additional collateral, then yeah, maybe we can provide pre-NTP financing for the other project, right, that's not ready yet.
So we've got a history of trying to be creative in some of the other spaces, solar and storage, where we'll do pre-NTP on a regular basis. I don't think we've evolved to that point in this market, but there are probably circumstances with the right equity partner providing a guarantee or an ECL where we could make a safe harbor bridge loan, not a bridge loan, but a safe harbor loan against some equipment or something like that. There's probably a scenario that could happen, but to this point, we have not gone down that path.
Yeah, the only thing that I would say is, so we have looked at back levered facilities for other. So if we're working with a platform company that has other operational projects, they might have debt on those projects, but they might have enough cash flow to support a back levered facility upstairs. We, JP Morgan, so not specifically my team, but we could look at a back levered facility that effectively they could use the proceeds for pre-development spend, right? So that's the other workaround.
Any other questions from the audience? Any other topics you'd like to hear covered? Do y'all have anything else you want to add or talk about this morning?
I guess I would say we had talked about this on the panel earlier that for all the roadblocks and the things that are in front of us, the industry, I kind of go back to the beginning of solar and how that market evolved, and then have watched this market evolve. There's some pretty good successes over the last couple of years that I think should be brought out. It's not all kind of clouds and rain. Lots of ITC execution and actually monetization. So different strategies are coming through. They're proving out. Folks that have never done ITC before have kind of figured it out, monetized the credits. The market is receptive to them. I think that's a great thing for the industry, having never done that before. Construction, we've talked a lot about that. We've had really good success with construction. I've had very few hiccups around getting to the finish line, commissioning projects, getting the COD. Now you have some stabilization challenges, with some of the things we've talked about, but very little construction risk. I think that's bodes well to the comments earlier about EPC selection and just structuring deals well. And then, the LCSF market, as much as we've kind of put a spotlight on that, and it's a big focus for us, the amendments have been approved, and the market forward curves indicate that once they're put in place, there's going to be recovery. There's light at the end of the tunnel there. And, we continue to hold on hope to that. And, if not, we're going to be having a different conversation next year. But I think that's a great thing. This program has been very successful, which has really kind of driven this and created a supply-demand imbalance. And once the amendments are put in place and that is corrected and rectified over the next 12, 18 months, I think that really bodes well for the industry and will be a positive thing. Last thing I guess I would mention, we've built a pretty nice network of lenders that are interested in this space, that have never lent in this space before, that have gone up the education curve. And whether it's just focusing on landfill gas or just focusing on contracted revenue, they've never lent into this space. And that network of lenders is bigger now, at least in the project level that I'm at. A lot of work in the last couple of years to build that network of club deals and people that will come in and play. So I think those are really positives for the industry.
All right. If nothing else, then we can end a few minutes and let everybody go to lunch. Thank you for joining this morning. We appreciate your time. Enjoy the rest of the conference.
Thank you.